Hello, everyone. Welcome to CAPIS's monthly research briefing. Great to have everybody here this week or today for our call. For anyone new on the call, welcome. And to our returning clients and guests, welcome back. Appreciate it. Today, we're excited. We have a new research partner to the call, BCA Research. They have been around for a while, and maybe a lot of you have heard of them, but aren't familiar with everything that they do. So we'll kind of clear some of that up today. And we're really excited to talk about some U.S. equities, and we have a U.S. equity strategist on the call with us today, so we're excited for that. There's a lot to talk about today, with what's going on. It concerns that, our U.S. equities overvalued. There's some macro factors on. So we have Noah Weisberger from BCA Research today to go over that with us. He's a U.S. equity strategist. This is exactly his specialty. So he's going to help us go through what's going on macro, diving into U.S. equities directly, looking at everything. Noah, welcome.
Thank you. Thanks a lot, and thank you very much for having me, and welcome to everybody who's zoomed in or teamed in here.
Yeah, we're
So
we're
let me
excited. Yeah,
great. So let
we're
me kick off. Thank you,
excited.
Steve. Yeah, there's
Yeah,
lots
we're
to
we're
talk
excited.
about, and let me dig right in. And I think the goal
Go ahead.
is to give it about 30 minutes of runtime and then open up to Q&A.
Sounds
Uh,
good.
and happy to address any question that comes to mind. We'll try to do our best. So let me start off a little bit with the map. Well, just a quick 30-second intro to kind of the way I try to think about the world, and hopefully you'll see that reflected in the presentation. I try to really sit at the intersection of macroeconomics, fundamental analysis, and quantitative analysis, and to really tighten the link between those three disciplines. Kind of start with a top-down outlook, think about how that manifests itself in terms of fundamentals, and then spend a lot of time asking what's priced and what's not, and do a lot with different baskets and factor exposure. So we'll get different pieces of that hopefully in a quick talk today. 30 minutes is like I was joking around in the prep call, which is I could talk really fast or cover a fewer topics. There's so much to talk about, and we'll dig right in. It's a great time to be thinking about these issues. So just want to start off with a very big picture of what the U.S. macro economy looks like. And we'll start off with a pretty straightforward picture here. This is our own contemporaneous indicator of economic activity. It's about 40 monthly time series. And as we go through the presentation, I think there'll be things that we do that are unique and differentiated and really special. This isn't one of them. This is a garden variety contemporaneous indicator. It's nice and smooth. It's meant to be scaled to GDP growth. And what we see here is that economic growth in the US is kind of low and steady-ish. But what we really want to focus on is the extent to which things are getting better or getting worse, which is why we look at it in this swirl graphic. And here we have economic growth on the x-axis and economic acceleration, the improvement or, is growth getting better or is growth getting worse? And when we first started, I've been at BCA since the start of the year in February. Back in February, we were over here. Economic growth was positive, but it was getting slower and slower sequentially. And I think what people tend to do is when they see things slowing, they naturally extrapolate that things are going to just get worse. And eventually, the US economy was heading towards a contraction. And in fact, you had three rate cuts priced into the bond market. That seemed to be where consensus was. And we made the historical argument that when you see the economy slowing, it can contract. You can go from positive growth to negative growth, or things can get better. And historically, more often than not, the US economy reaccelerates rather than contracts. And that's actually what we've seen in the last couple of months. The US economy has started to see growth from a fairly low level and fairly moderately start to improve. And to us, that kind of just sets the table for how we should be thinking about risk assets. And here we have average S&P 500 performance, monthly returns annualized in the four phases of the business cycle. When economic growth is positive and getting better, which is where we think we are now, when economic growth is positive and getting worse, which is where we were coming from, and then the most robust phase is when the economy is doing worse, and then all of a sudden you see a bit of a sign of an improvement. So we think we're somewhere in this region here where economic growth seems to be solidly positive, and we see some signs that things are getting better. This tends to be a favorable environment for risk assets. Digging in beneath the hood a little bit, I think this is probably obvious to a lot of people, but it's worth keeping in the in the front of the mind, which is this is an investment cycle. So here you have non-residential fixed investment growth and the consumer. So the best thing we could probably say about the US consumer right now is slow and steady. And the real driving force of the US economy is coming from the investment side.
Noah, let me
Yeah,
ask you a
sure.
question. Is there a way you could possibly expand your screen a little bit without occluding your face?
Yeah,
Um,
tell me if I'm doing it. I can,
Let me
first of all, I
see if we
can,
get a little bit of expansion here in size. If not, no worries, but
did that do
that's
anything?
perfect. That looks really
Okay.
good. Yeah,
Okay.
thank you.
And I can go back a second if this was unclear, like the swirl was probably a little tricky to see. But the basic idea is that the US economy was going through this period of positive growth and slowing, and has hooked up around. We think things are positive and getting better, and we think that's mostly being driven by the investment side of the economy.
Okay.
All right, all right, all right. I'm gonna keep going. I think we're good now.
Yep, I
Oh,
think
I
so.
see. I apologize. I don't know why it's I can do better than that. Let me try one more thing here.
Okay.
Is that better?
Yeah,
Or is
I mean,
that
I
too
see it
big?
even bigger now. Yeah,
Great. Wait. I
yes,
apologize
that's
for
great.
the
No, that's quite
clunky
all right.
technology.
This one's
All
good.
right. So, and then if we dig even further into the investment side of the economy, it's really anything that's kind of computer information processing equipment related. That's really been the driver of this economy. And obviously, where is that coming from? It is this AI driven CapEx spending. So this is CapEx spending for the S&P overall, and these are the hyperscalers. It's important to point out, though, that this CapEx spending isn't just influencing or affecting the technology sector, as we'll talk about in a minute, but it really is helping to lift the old economy as well. And a lot of people talk about all the spend on computer goods and semi chips and things like that. When we've looked at the hyperscalers themselves, about a third to maybe a little bit more than the third of that spending is actually old economy. So that's why I think we're seeing a great strength also in the industrials and in the material sectors as well, which we'll get to in a minute. But there are a lot of worries that this ramp up in capex is causing for investors. And as we go out to talk to clients, the concerns are expressed about the degree to which this amount of capex spending is a bubble. It's not going to be supported by demand. The extent to which this capex is leading to leverage problems, and the extent to which this capex uptick is changing the nature of the tech sector from being an asset light to an asset heavy investment, and it's sort of cannibalizing free cash flow, which is one of the things that people really liked about the tech sector. So just to give a little bit of balance to some of those fears, um, the first thing that we would note is, in fact, we are seeing a bit of a shift uh, between returning cash to investors for the S&P 500 overall. So this is the green line here is returning cash to investors either through buybacks or through free cash flow. And this black line here is CapEx as a share of operating cash flow. So a company generates operating cash flow. They could either bank it as free cash flow, they could buy back their own stock, or they could pursue investment opportunities. We don't include R&D, we include just CapEx, but there is a noticeable shift in the overall market, not just in the tech or the hyperscaler space, where we're seeing returning cash to investors going down and CapEx spending going up. As a matter of theory or philosophy, I believe that part of the reason why an investor should buy an equity is not to get a buyback or to get a dividend even or a cash flow. It's really so that the equity can make investments that aren't available to the individual investor. So I kind of like to see the equity market investing in capex. That said, that also comes with a lot of risks. It's not always been clear that the market rewards those who spend on capex. We think that's changing a little bit, and if we talk a little bit more later in the presentation about how the market is pricing these different risks, in addition to seeing a shift in how the market is behaving in terms of returning cash to shareholders versus taking an investment or taking a forward risk, we also think the market is starting to reward these behaviors a little bit differently and starting to reward people spending for growth. So this shift is definitely happening. The other thing I will point out is that even though we are seeing a big ramp up in capex spending, for most sectors, even though we're seeing a big pickup in capex spending growth, most of them are able to still maintain significant free cash flow growth. And in fact, free cash flow growth for most sectors is growing more quickly than capex growth. The one area that people are most worried about are the hyperscalers, right? The hyperscalers are really just seeing massive capex spending growth. They've churned through their free cash flow, and that really is an area of concern for a lot of people. We're a lot less worried And I'll show you why on the next slide. Uh, so on the one hand, hyperscalers are starting to tap the debt markets. So undeniable, as they've churned through their free cash flow, they are going to the debt markets. But for the overall market, very little sign of an increase in leverage. And here we're looking at debt to EBITDA, so debt to earnings before taxes and depreciation, interest expense, taxes and depreciation, and debt to EBITDA, despite the fact that CapEx spending is picking up for the overall market, and despite the fact that people are worried about what's happening to free cash flow in the balance sheet, we're actually seeing a decline in debt to EBITDA for the S&P 500 overall, for the tech sector specifically. And the hyperscalers were actually are seeing some increase in leverage, but below where they were just a couple of years ago. So true, they are shifting, companies writ large and the hyperscalers most dramatically are changing their behavior a little bit, but we don't particularly see this as troubling. The one thing we are laser focused on in terms of evaluating the CapEx spend, is it excessive? Will it be able to be turned into earnings? Is return on equity. And so that's the one place where we think there is some pressure on the hyperscalers. Hyperscaler return on equity peaked around 29 in a couple of years ago in 2024. We've seen it fall in 27, and we expect it to continue to fall in 2020 in 25 rather. And we expect that downtrend to continue in 2026 and 2027. So this is an area that we are really focused on. Investors like to see a high ROE. They like to see an ROE that's stable. And can these hyperscalers turn their investments back into cash? And how do they do that? They do it through earnings. How do they generate earnings? Two numbers: revenue growth and margin expansion. And if we can see these companies grow their revenues, and if we can see their margins expand, then we'll be very comfortable that they can grow back into their return on equity despite the CapEx. If we were to see their revenues grow, it would be proof in the pudding that there is demand for what they're building, right? The big concern anytime you're doing a long-term, uncertain investment project is that you're building excess capacity. By the time the demand shows up, it won't be enough to justify the build out. And that's the big worry. But if we see the revenues start to grow, we'll be a lot more confident that this CapEx is to meet demand, that it meets the expectation of demand. That's kind of how you would think about the problem. I'll argue in two slides the situation is actually way better than that. The hyperscalers are expanding CapEx not to meet expectations of future demand, which may or may not materialize. They're expanding CapEx today to meet demand yesterday, as it were. There's a real constraint in the market. There's demand for these goods that needs CapEx, and there's a long runway. So let me kind of go through that really, really quickly. And I think this is a meaningful band-aid, or even better, a meaningful answer to a really big risk that people have posed. And so the first is, this is just looking at cloud revenues, but cloud revenues for these hyperscalers are growing and they're quite large. And the other nice thing about seeing revenues grow is that if you have the right corporate structure, every dollar in the door costs less than a dollar to make. In other words, you have operating leverage to that revenue. And when we look at corporate margins tend to expand when revenues are growing. That tends to be true for tech, and it's incredibly true for the hyperscalers. And one way to keep track of that one of my favorite measures out there, is looking at sales per employee. And so this is the ability of a company to turn a dollar of revenue, a dollar of revenue based on how many workers that they need to produce it. And so it speaks to the efficiency. And here you can see the median tech company revenues per employee on the way up, and the hyperscalers themselves. So the combination of visible demand for cloud, for AI, and so on, plus their corporate structure, is why we're confident to let this thing run and make the argument that CapEx is not excessive. So, two of the concerns about the big CapEx spend we've seen are: one, it's going to blow up balance sheets. We don't think that's the case. And two, it's excessive. It's going to kill itself because the return on investment won't be there because there's no demand. We don't think that's true either. And not only is there demand, we think demand creates margins, and that creates earnings, and that's how you cash convert your CapEx into earnings for investors. And just to kind of go from hard data to a really, really important anecdote that we got out of Q1 earnings calls. It's almost like, one of the things that you try to look for when we're building the portfolios. Like what doesn't the market know and what can it learn? And I thought for my own self, I had done all the macro analysis and data analysis on the excess capacity question, and we looked at lots of different macroeconomic indicators relative to past bubbles, and it was convincing, but it still would make me toss and turn at night. Like, are we making the wrong argument? Are we going to like drive over the cliff? And then we got Q1 earnings, and we looked at all the earnings commentary through AI, asking it like what we thought were kind of smart questions. And I try not to use superlatives a lot, but I think I couldn't have asked for more out of Q1 earnings season, both in terms of the surprises, but then also in terms of what the companies were saying about themselves. So let me just read these quotes to you, and they really were like, wow, that's new. Like I didn't realize what was going on. Customer demand, this is from Microsoft, continues to exceed supply. We expect to remain constrained at least through 26. Uh, we are compute constrained in the near term. Our cloud revenue would have been higher if we were able to meet the demand. So a moment ago, I was talking about CapEx as the ultimate investment for the future. I would argue that we're investing for the past. Revenues would have been higher had we already had the CapEx in place. That's shocking. Now, I don't want to sound like I'm only like a one-way train. I guess trains are always one way, but like I'm a one-minded, there are no risks. I think ultimately the risks medium to longer term around the AI and CapEx spend end up being about the competitive landscape, meaning we have Alphabet and we have Amazon, and they are playing a game of chicken, and they both like handcuff themselves to the steering wheel, and they're going for it. They need to spend. If they don't spend, they lose. Like I always think of the Cold War. Like the way America won the Cold War was we just spent, and we could spend because we had a dynamic economy. So these two companies are going at it, not just two. What does the ultimate ecosystem look like? Does it look like a duopoly where they both survive? Does only one of them survive? Or do we end up with a very competitive landscape? Very hard to pick winners and losers, very hard to handicap what the world will look like 3 or 5 years from now. But for now, these guys are spending for near-term demand. And as we'll see in a moment, that's coming through in terms of really, really strong earnings strength. And if, put feet to fire, why am I still constructive on the US equity market? Earnings/earnings quality. And until that changes, I'm going to try to be constructive. We also need to talk about the valuation of the market, but we're trying to make the argument of, the macroeconomy looks supportive. What's supporting the macroeconomy? It's investment spending. Where's that investment spending coming from? It's coming from the hyperscalers. Do we think that CapEx is excessive or leading to excesses in terms of leverage? No and no. There's still some risks around it, but the next thing we'll need to talk about is the strength of earnings that that's generating. So finally, going from anecdotes to numbers and kind of showing the impact of the CapEx spend, not just on the AI complex and the AI stack itself, but in the old economy stocks. Here's what backlogs and book to bill looks like for some key companies within important sectors for the AI build out. And to me, these are stunning numbers, right? Book to bill is a ratio of their bookings to how much their annual revenues are. So we're talking about a year to 2 years of visibility on demand in the old economy. So that's why I said before, I said it kind of in a cheeky way, that CapEx isn't being built for the future, it's being built for the past. The demand seems to be there. These are companies that have operating leverage. They should be able to convert to cash and solve their ROE problems, and they should be able to generate earnings on the back of that. So let me now turn to the earnings outlook, which ends up being really, really central to our constructive stance. I guess some more really awesome quotes from some of the old economy companies. Here's a great one from Western Digital. Our long-term visibility continues to improve. Agreements out to 28 and 29. So our own forecasts don't go out that far, but you have companies on the record talking about their order book 2 or 3 years from now. And within BCA, I don't know of the folks on the call how many are intimately familiar with BCA. I just joined. One of the things I love about BCA is that it's an open intellectual place to muck around, and each strategist basically has carte blanche to come up with their own views. And I'm more constructive. There are folks within BCA who are less constructive. Ultimately, I think the debate, bull bear debate within BCA, and when we talk to clients who are less constructive, ends up being about not about the near term, it's about those long term competitive forces and how far forward the market is willing to look. And we think that this visibility on earnings this year, next year, and probably the year after really is what seals the deal for us. So analysts, bottom up analysts, this is 2025 year-end EPS estimates. 2026 and 2027. And three things to note. One, sequentially year by year, earnings are going up. And even within each year's estimates are going up. In other words, bottom up analysts think that the earnings outlook is improving year by year. And as time goes on, each year is getting better and better. So, as optimistic as people have been all throughout 2026, they're increasingly more optimistic about 2027. At some point, growth will slow, but we're still revising up 2027 expectations. And that's not just true for the market overall, it's true for the tech sector as well. So, as good as things have been, bottom up analysts expect things to continue to be as good, if not a little bit better. And so when we look at that across sectors, here we have expected EPS growth. So for the market overall, almost 20% expectations on a forward 12-month basis. And that number has been revised higher over the last 3 months. Energy, obviously, some special factors driving that. But look at technology. Even at this level of expectations have continued to improve. And one of the nice things, so I'm a cynic. No one really knows me well enough yet, but I'm a terrible cynic, and I'm especially cynical about bottom-up analysts because I'm a top-down guy. But I will give them the credit that they deserve, which is when we plot bottom-up consensus expectations for S&P 500 earnings growth. That's this black line. So this is a 12-month forward outlook, and then the green line is what the companies actually deliver when we get to that period of time. It's pretty highly correlated. So bottom-up analysts do a fairly good job of predicting the earnings cycle. Where they don't do a good job is predicting earnings downturn. So if you look at these green lines, we do see earnings recessions every so often. Bottom-up analysts never call that right. So one of the things that we try to do is recalibrate bottom-up expectations to take account for the fact that at some point, like when bottom-up expectations are around 8%, that's when you're likely or more likely to see a contraction in realized earnings growth. And so we've calibrated that number across all the sectors. And when we look at the bottom-up information, this is a bit of a complicated chart, but focus on the red dot. The red dot is where historically, at that point, if analysts are expecting, for the S&P overall, 8% earnings growth from the S&P 500, that's when historically we've started to have problems with maybe there'll be an earnings compression realized when we get there. We're far away from those levels. So we think there's an optimistic upside story, but we also think there's no evidence of really being nervous to the downside. And that's really, really important for us. I'm getting in close to my half hour self-imposed constraint. So I want to just talk about two more things. Ed, was there a question coming through?
No, we're good. You're
Okay,
good on time, but yeah, go right ahead, Noah.
yeah, no, I just want to be conscious. I don't mean to talk over you.
No, no.
I just want to talk about valuation, kind of give you some of our numbers and the outlook. And if I have a minute or two left, I'll pivot quickly to talk about IPOs, although I suspect there'll be a lot of questions about that on the line directly. So again, just to kind of trace through the argument we're trying to make here today, which is to start with the macro outlook, which is favorable. To then argue that we kind of know what the drivers are. It's the investment side of the economy, not the consumer. If anything, the consumer's been a nice little surprise to the upside, but that's not the exciting part of the driver. Is then to argue that the CapEx spending, which is supporting the investment spending overall, is neither excessive nor leading to real balance sheet problems. There are concerns about the ability of the spenders to generate return on their investment and a return on equity that investors have become accustomed to. But we think there's a clear path back to that, in part because these are operatingly levered companies with a lot of efficiencies. The earnings outlook, we think, therefore, is robust, both in terms of our own macroeconomic forecasting, but also using bottom-up expectations. And at the very least, we don't see numbers being weak wobbly enough to be thinking, hey, this is consistent with a historical earnings recession. That leaves aside the question of how much are you willing to pay for this level of earnings, especially given how much the market has rallied. And here, let me quickly put up a lot of people. Well, let me start with this chart. I don't think I have it here. I apologize. Let me start with this is a PEG ratio. So it's price to earnings of each sector divided by that sector's forward growth rate. So we're trying to normalize for the fact that when you look at a PE ratio, a typical valuation ratio, you're picking a point in time of earnings. And you're picking a point in time currently where we think tech earnings are really growing quite rapidly. So how do you control for the fact that different sectors are experiencing different growth rates? It's another way of saying that PEs don't capture everything there is, and that valuations miss sometimes the forward outlook. And if you look at price to earnings relative to the growth of sectors, the story is actually quite inverted. And people talk about tech being super expensive. Well, if you control for growth, tech is actually cheap relative to other sectors. And staples, which I dislike on any number of metrics, is actually quite expensive, mostly because it has very, very poor growth prospects, in part because that's where a lot of the Gulf War price pressures are showing up. So on a PE to growth basis, tech is relatively inexpensive. Amazingly, what happened over the course of the Iran Gulf crisis, I always call it like the pre-war and post-war period, and I don't mean like 1920, 1940, I mean like February and April. In the market sell-off through March, prices came down quite a bit, and then they rallied really, really quickly. But they didn't rally fast enough to keep pace with tech earnings, with semiconductor earnings, and so on. So you actually came up with a situation where coming out of the war and even into the rally, tech and semis were less expensive than they were going in. That's kind of remarkable. The other statistic I like to keep in my head is that the semiconductor space, it trades at like a 50 multiple relative to current earnings, and it trades at like a 20 or a sub 20 multiple if you forecast in 1 or 2 years forward of growth. Now, will we meet those growth expectations? I'm not sure, but that ends up being the decision point, which is our earnings growth expectations. My opinion, they're based on really good visibility on demand growth. Will those be met? And if those will be met, valuation per se isn't the risk. Just to talk a little bit about current events, and I'm sure we'll get more into that in the Q&A part. We see three big forms of risk to that multiple. One is like the cyclical inflation period picture. The second is the longer term balance of monetary policy and fiscal policy in the US. Like where should rates normalize to? What should the bond market term premium be? Are bonds more or less risky than in the past? And how do stocks and bonds move relative to one another? That seems to be a more persistent risk. And then finally, I'll talk about this in like for a minute, the big wave of IPOs. That probably is a multiple issue. It's definitely not an earnings issue. And again, multiples in and of themselves aren't troubling. Multiples have a poor record for predicting future returns on a 1 year or even 2 year basis, but it does open up the equity market to be vulnerable to what I call external shocks from the rate market or the bond market or bond market uncertainty. That's the biggest channel of risk that I see. It's not that the market's going to collapse on its own weight because we can't support the valuations. We can, but what if the external environment for how much risk appetite there is changes? I think that's the biggest risk. So with a minute or two left, let me leave you with two numbers and then a picture or two about IPOs. So just to put a number to it, these are numbers we put out at the beginning of February. We have a $308 target for the end of 2026. We are now significantly below bottom-up consensus expectations. This started off a little bit below bottom-up consensus and around average with other macro strategists. We are meaningfully behind now, and our target is 7,700. Again, that felt like a pretty decent runway, like a 12% return. We're already there. So we're about midway through the year. We're going to do a relook at our forecast in the near term. But right now, we have a $308 earnings number and a 7,700 target. One last thought on our outlook. No surprise, given the way I've tried to categorize the current macroeconomic environment. We are overweight materials and industrials. We are overweight technology. That's basically one theme. We are underweight utilities. We are underweight staples and discretionary, both for some idiosyncratic reasons, but also because of their defensive characteristics. And then we're market weight, healthcare, financials, and real estate. In terms of more tactical outlook, we initiated a long position. And so at BCA, we have our strategic outlook, which you see in front of you. And then we have a more tactical outlook. More tactically, we're long material stocks and we are long consumer discretionary stocks, essentially playing both the strength of the business cycle on the material side. The fact that when we launched that materials trade, we thought that the Gulf crisis was unlikely to escalate further. And so we'd see energy prices fall, but materials prices and other commodity prices probably not, boosted by the cycle. And then we got long consumer discretionary stocks following the last week's getting closer to a real resolution in the Gulf. Um, Again, just to intersperse conversations that we have with clients, tons of conversation about AI and CapEx, very little conversation about consumer strength or anything else. And so the other thing we were thinking is that's a bit of a quote unquote pain trade. No one's really expecting much from the consumer. And so we're trying to take advantage of an area that's under owned. Maybe people rotate into it. So we'll see how that goes from a tactical perspective. Um, the big issue in the room that we are worried about is the IPO cycle. I'll do one quick IPO picture and then I'll turn it over. This is an unreadable chart, but it's kind of cool. It lists the biggest few IPOs each year and a few of the very, very well-known big IPOs. And I think there are a couple points that are worth keeping in mind about IPOs in general. I think IPO seems to be like the quintessential phenomena where people fall into typical behavioral traps. Like people remember great IPOs and they remember terrible things. So when we talk to clients, there are two kind of pieces of conventional wisdom, neither of which we think are true. The first is that IPOs are awesome, and the second is that IPOs lead to market crashes. And I think what we would say is most IPOs, and I'll be a little statistical here for a second, the median IPO, looking back over 40 years and 12,000 US IPOs, the median IPO doesn't underperform the market. The median IPO goes down in absolute terms on a 1 month, 1 year, and 3 year basis. Not the initial pre-IPO to first public day of trading, but from the day you're a public company onward, the median IPO goes down. The average IPO goes up a lot. So that means to say there are a lot of IPOs that are pretty crummy and a few IPOs that are awesome, and we remember the awesome ones. The second thing I would say is that most market peaks do not coincide with large IPOs, and most large IPOs do not coincide with market peaks. There's some that we remember, but the accurate statistical statement is to say that large waves of IPO tend to mute forward returns. The market tends to slow. And the second thing is that the probability of seeing a market peak is higher if you've seen a huge IPO than if you haven't. Not over 50%, maybe more like 15 to 20%, but not, oh my God, we're at a market peak, it's going to crash. Odds are higher that you'll see a market peak, but not definitive dispositive that you will. So that was a 30-ish minute whirlwind tour of how we see macro fundamentals and some
Mhm.
of the risks. We talked a little bit less about quant and market pricing, and happy to talk about that in the Q&A. But let me turn it back over to you.
Yeah, that was fantastic, Noah. You covered a lot there and really appreciate it. I did have a question on slide number 30. If you went back to page 30, you were market weight financials up, I believe, but overweight banks. Could you provide a little distinction there? And yeah, we definitely have clients that are banks on the call, and I was curious if you could kind of talk about that for a second.
Yeah, so it's also in distinction from the private credit. So the overweight on banks hasn't been a great call. It's a little bit of a value play, and a little bit has to do with how we expected back in February the regulatory environment to evolve and the bond market to evolve. And I think that hasn't played out. And honestly, we are looking for ways to diversify our own sector weightings. And essentially, it comes down to either financials or healthcare are the only two sectors of note with enough market capitalization. Again, just to intersperse, we've had very little take up on the financial debate. We dislike private credit managers, which we kind of cobbled together ourselves because of their software exposure. But we also thought, we also had a tactical long in software a couple months ago. We didn't shift our thoughts on the financials. One other interesting tell for the market in June, just to kind of go to this point of looking for diversification. If we look back over the last year, we've seen an incredibly clear relationship between returns, so sector level returns, and sector EPS growth. So if you made a scatter plot of EPS growth on the x-axis and returns on the y-axis, you have a very, very beautiful relationship, like a high correlation between companies that have grown EPS and their returns. In June, that broke. And what you basically saw is healthcare rally, tech slump, but healthcare earnings are weak and tech earnings are strong. And so I think we're at risk of is that moments of worry, and I don't think this is like a bear market or a persistent downturn, but I do think we'll see these rotation trades where people will take the opportunity and go, hey, wait a minute, I've been in tech, I've had the right call, I've been market weight tech, but now I feel that's such a huge weight, or I've been overweight tech and that's grown. And so I think there's a rebalance that's going to go on, and the only destination for those dollars essentially are healthcare or financial. So I think that's another reason you'd want to lean into financials a little bit, is that it's the like the Tina, like there is no other alternative. And this is the only other alternative, right? Like, meaning we're overweight materials. How much can we reasonably expect an investor to put in a 3% market cap on the back of that? So I think if people want to get out of some of their technology exposure, it's got to be the other large cap sectors that are the beneficiaries.
And by large cap, we're talking about large cap financials, the big boys.
Yeah, so to be clear, we mostly play in the S&P 500. So by large cap, I mean the large weights within that index. I mean, we also look at size and style and so on, but typically when we forecast into our sector allocations, we're talking about the large cap S&P 500 benchmark.
Okay, great. Well, thank you on that. If there's any questions from the audience, as usual, for those who are returning or anyone that's new, just go into the chat or throw a question in there on the Q&A, and I will read it to Noah. If anybody has anything they'd like to get out of Noah right now while we have him live, please jump in there and do that. Noah, earlier you were mentioning, you started off the call talking about CapEx and how the large technology companies, if anything, were playing catch up. That's great for them, but what about whether it's technology or even other industries and sectors, small to mid cap, can they compete? Are we looking to see? We talked about IPOs. Are we looking to see a flurry of M&A activity due to I can't compete on CapEx?
I think that's a great question. And I think one of the things that we have on our whiteboard, and I would lean in that direction. I mean, I know that small cap has caught a bid recently kind of on beta, right? So I get that also. Um, to me, this is both like an opportunity and a risk. My own view is that I think this becomes a scale game. And I think the Amazons and the Googles are the dominant players because they can own the entire AI stack. And I always liken it to like the commodity super cycle where you kind of wanted to own the integrateds, right? Because in a commodity super cycle, oil prices are going gangbusters, but if you're a refiner, your margins are also squeezed. So you don't want to be beholden to any point in that supply chain of AI. I think you want to own the whole thing. So I think that speaks to large cap. I think it speaks to M&A. I think the risk is short term. I think AI and the profits that these companies are going to generate will become a political issue. I think either that's a post midterm issue or it's a new administration issue in 2028. And zooming out even further, if I think about one of the biggest drivers of equity market performance over the last literally 30 years has been the expansion of margins, and that can be traced to market concentration. And I think, again, if I'm a regulator or if I'm a populist politician and I'm looking at corporate tax rates that are the lowest they've been in 30 years and concentration that's the highest they've been in 30 years, and a couple of really big name technology companies, and they bundle together an AI robot with their operating system, and they own the semiconductors and they own the data center. I think that was really interesting to me from a regulatory perspective. So I think that's the trend. I think it exposes you to a political risk, but that may be further down the road.
All right, that sounds good. Thank you for that. Any questions? I know some people sometimes have a problem with the chat. You can also go to Q&A or raise your hand. I will get the question to Noah. But Noah, thank you so much. This was really unique. And one thing I mentioned earlier in the call is that we try to get a variety of independent research providers, and you saw things and brought to us a unique perspective today to our clients and our guests and friends and myself. And I thank you very much for that. This was a fantastic call.
Great.
Um,
I appreciate. I've enjoyed talking to you guys, behind the scenes. And I really thank you for giving me the opportunity to talk to everybody today as well.
Noah was mentioning before the call that he could or BCA could send out the slide deck for anybody that's registered for the call that wants to get into these slides and take a look at some of the stuff we talked about, or even get to some of the slides we didn't have a chance to do today. We could send that to you. So I would say reach out to the person that invited you on the call, and we can go ahead and email that to you. Also, BCA has indicated to us that they are willing to give anybody that's registered for the call a free trial. It would be a 60-day trial to be able to view their products and services. no obligation. So we can go ahead and get that set up for you. And I think us or BCA will reach out to you if you register for the call and go ahead and see if you want to partake of that opportunity. And I think I'd encourage it. It's fantastic what BCA has to deliver. And you got a taste of it today with Noah. So it's fantastic. Appreciate it, Noah. Thank you so much.
Great. Thank you very, very much. And have a great weekend, everybody.
And next month, we're going to have Markets Policy Partners, July 16th. As you may know, they're macroeconomic. We'll get into our new Fed chair there and try to plot some interest rate discussions for the coming year and look at some other macro and political factors. So until next month, thank you, everyone. Have a great day.